The broadcast is now starting. All attendees are in listen-only mode.
Hello, I'm Sam Stovall, Chief Investment Strategist of CFRA Research. And thank you again for tuning into this follow-up video. We had one just a week or so ago as we discussed the corona crisis. We discussed the new bear market that we had slipped into since making a new all-time high on February 19th. So you're wondering, why are we having another video conference call? And actually, it's basically so we can keep pulse with the market, share with you what our feelings are, how much longer could this go, how much deeper could prices fall, and also sort of set you up for another video conference that we will be offering on April 7th at 11 o'clock. There we will be discussing again more about the bear market, also talking about the first quarter earnings outlook and what is likely to be delivered by companies, and then dive into one of the more battered sectors, that being energy in particular, and then following it up with the mutual fund and ETF recommendations as they relate to the bear market in general, but also into energy in particular. So why don't we get started talking about the 3 R's: retreat, rally, and recovery. Well, in terms of talking about retreat and rally, as you can see from this table, the S&P 500 fell almost 34% from its all-time high on February 19th to its most recent low on March 23rd. All 11 sectors in the S&P 500 were in negative territory. In addition, we had mid-caps, small-cap stocks, as well as their growth and value components deeply in negative territory, all of which were in double-digit decline mode. So also we see from the left-hand table that it was the defensive areas, consumer staples, healthcare, that actually held up relatively well. Gee, why were utilities not on that list, nor real estate? Well, one reason is because investors had piled into these two income-oriented sectors, chasing dividend yields. So once we then fell into a bear market mode, these investors who were probably better off sticking with bonds decided to bail out, and as a result punished the groups that traditionally would be better than market performers in swift sell-offs. But then from March 23rd through March 26th, a very quick 3-day period, the S&P 500 on a closing basis gained almost 18%. All 11 sectors were in positive territory, gaining by double digits, as you can see. For the more defensive groups that held up very well during the decline, a rising tide lifts all boats, so they benefited, but not as much as those groups that had been beaten up the most, such as energy, industrials, utilities, financials, etc. What's also interesting is that from the intraday low on March 23rd through the intraday high on March 26th, that 3-day period, the S&P 500 gained more than 20%. So I had many people ask me if we were in the beginning of a new bull market because we rose 20%. I said no, because we traditionally need to see a bull market mode be in existence for at least 6 months before we can actually say that we are in a bull market mode, because each of the 3 mega meltdowns since 1970, meaning 73, 74, 2000 through 2002, 2007 through 2009, each of them had at least one 20% rally off of a retreat that soon ended up giving up that increase. Specifically, in 2008, the market bottomed on November 20th. We were down 52%. Yet we rallied more than 25% into early January 2009, only to fall and then undercut the November 20th low, bottoming out at a minus 57%. So I told investors, don't pop the champagne cork just yet, because we probably have to go through a retest mode before we can actually say that the retest rally has now run its course. So let's take a look at the next slide to discuss why is it that the market has been declining. Well, obviously, it's the near economic shutdown as a result of the coronavirus, ensuring that we don't overload hospitals with cases early on. I think most everybody who was going to get it will get it, despite quarantining. They just wanted to make sure that it was distributed over a longer period of time than overwhelming the hospitals in such a short period of time. As a result, with many non-essential businesses being closed, actually earnings expectations are coming down quite dramatically. The beginning of the year, actually there's a little typo that I put in here, 12/31 of 2019, the estimate for 2020 earnings was 7.9%. At the market peak, however, earnings forecasts have been coming down a bit, so the forecast was for a gain of 5.8%. Most recently, however, S&P Capital IQ consensus estimates believe we could be off by 5%. Now, obviously, that's a question that is still outstanding. How low can we go? How much can earnings actually be coming down? Well, we can use history as a guide, obviously knowing it's not gospel. If we take a look at the next slide, what we find is that going back to World War II, we have had 12 recessions. And this table shows the first grouping is the recessions themselves, how long they lasted, what kind of decline did we see in GDP from peak to trough. What about the S&P 500? What kind of earnings changes did we see? What kind of price changes did we see during that recession? And what was the ultimate PE low during the recession? But we all know that the S&P 500 is a discounting mechanism. It anticipates recessions. So hence the grouping on the far right-hand side, corresponding corrections and bear markets. We have essentially had multiple bear markets and corrections prior to the beginning of a recession. And in fact, the S&P 500 anticipated these recessions by almost 8 months on average. So the question is, okay, well, during those recessions, by how much did S&P 500 earnings fall? And the answer is minus 10%, highlighted in yellow. Also, the question is, then if earnings are coming down, the optimism of investors is also likely to be coming down. So what was the PE ratio at the low in this recession toward the very end? And the answer is about 12 times. So now the question is, well, what if we ended up with a 10% earnings decline rather than just the 5% we're looking at now? And what if we ended up with a PE multiple that was closer to the historic average of 12 times? In the next slide, you'll see what that answer is. In 2019, the S&P 500 posted earnings of $163.94. That is the column in the first grouping on the left are 2020 earnings estimates. So the 163.94 is what we did earn in 2019. Well, what if earnings came down only 5%? Well, that's the 155.75. What if it came down 10%, as is historically the norm? Then it would be 147.55. So the estimate therefore translates to, well, what kind of percent change could be affected to the all-time high that was reached on February 19th, and what kind of a percent change would be required from last Friday, or I'm sorry, from March 31st in order to then get to this bottom. So in a sense, the worst case scenario shaded in blue is a multiple of 12, looking at a 10% earnings decline to 147.55 for this year, implying that the S&P 500 could bottom around 1770. That would represent about a 48% price decline from the all-time high. Certainly what I call a mega meltdown bear market, and one that is similar to what we experienced during the tech bubble bursting in early 2000. and probably even more painful is that it's a near doubling of the decline that we had already experienced through March 23rd. So this just sort of puts history into context of, if we were to see a traditional decline in earnings and a traditional PE contraction, what would that mean in terms of the price decline and overall percentage change for the S&P 500 from the all-time high? Let's take a look at the next slide, which in a sense agrees with this kind of a magnitude of decline. What this table shows is that going back to World War II, I looked at all of the preceding bull markets, and the subsequent bear markets in many ways were a reflection of how strong the prior bull market was. So in terms of three categories, one is the length or the duration of the bull market. If it was longer than the median, it was on the right-hand side under long. If it was shorter than the median, it was under the left-hand side under short. Percent gain, if it was above the median, and this one was the second highest rising bull market since World War II, then it would go onto the right-hand side. If it was less than the median, it would be on the small side. And then the PE ratio at the top of this bull market was actually second most expensive, so on the right-hand side as compared with the cheap category. So then what I did was, with each one of these bull markets, whether they were long, large, expensive, I then said, well, what was the corresponding bear market? What was the bear market that followed these bull markets of duration, gain, and valuation? So what we'll find then is the average on the bottom, and duration of bull and percent gain, we see the same distribution, that if you were short and small, then your bear market was only 29%, where if you were long and large, it would be a bear market decline of 38% on average. Going and adding the multiple at the very top of this bull market then implies that we probably could tip into what I call a mega meltdown, or a bear market decline of 40% or more. So again, history from a different perspective implies that yes, we probably could have a deeper than 34% bear market, which is what we have already experienced. Let's go to the next slide. Might as well pile on in terms of negative indicators. We just concluded the month of March, and March was down, as was February of this year, as was January of this year. So this makes it only the 7th time since World War II in which the first 3 months of the year were negative. And of those prior 6 times, 1953, 73, 74, 77, 82, and 08, what we find is that only one of these observations did the market rise for the full year. The remaining 5 were in negative territory, declining almost 15% for the full calendar year. Even the percent change for the remainder of the year, meaning from March 31st to December 31st, only one of those years was it higher, and that was again 1982, as we were coming out of recession, and about a month or so after Business Week posted on its cover the death of equities. So the rest of the year ended up declining 8.5%. So not a good indication as to what might befall us as we conclude 2020. The good news is that 5 of 6 times the market was up by almost 15% in the subsequent calendar year. So obviously getting all the negative news out of the way in 1 year then set us up nicely for the next year to be positive. So what could be some of the indications that would allow us to think that maybe 2020 could be like 1982, where we actually end up higher for the remainder of the year? Well, let's take a look at the next slide and realize that there has been an awful lot of central bank and government stimulus that has been pumped in at a record amount of time. The Fed fully put its foot to the pedal and cut short-term interest rates by 150 basis points in March down to zero. Resurrected the money market mutual fund liquidity facility to ensure that the money markets would be able to repay their investors. It expanded the assets that they can purchase to include municipal bonds. We just also added the ECB. So internationally, the Pandemic Emergency Purchase Program, Bank of England also cut rates, infused security into the pound, did some bond purchases. The Switzerland National Bank had currency intervention and was offering some ease for its banks. Back here in the US, withdrawals from 401ks and IRA retirement accounts could be done penalty-free. And the US Congress just recently passed a $2 trillion stimulus package. And now the government is talking about another stimulus package in the form of infrastructure spending or just additional checks to Americans to help them keep their heads above water. So what's happening is that as we watch the coronavirus, looking for it to be peaking in the US as it has already done in South Korea, in China, and appears to be peaking in Italy, we are looking for that as well. And I think investors are going to take that opportunity to dive back into equities once it appears as if the worst is behind us, certainly because we are likely to see a very strong pop in the stock market because of all of this central bank and government stimulus that is priming the pump. So now the question is, when could this happen? Well, if we take a look at the final slide, what we see is that the market will basically tell us when this is going to happen. Fundamental data will be lagging in nature as it usually is. So economic data is really only going to be beginning to show that we are slowing down. Corporate profits are only going to be beginning to show us that we are headed lower. So as a result, I think investors need to take their cue from the market itself. This chart is a rolling 15-day average of the percent difference between intraday high, intraday low. So essentially just saying, okay, what was the percent spread between the low and the high every day, and then plot out the 15-day average. You see that we have multiple stalagmites that point to, let's say, November 3rd, 1987. Interestingly enough, that was about 1 month prior to the actual low in early December of 87 for that bear market. September 17th of 1998, long-term capital management. We went through a near bear market, and that was also within a month. The market bottomed in very early October of 2002. Here we see the spike of August 7th. Now you might be wondering, gee, well, October 28th of 2008, that's a long way before March 31st. But interesting, most stocks within the S&P 500 actually bottomed on November 20th. Which was basically less than a month after this volatility spike. And that March 9th of 2009 ended up being simply a successful retest of the November 20th low. So I would say look to this volatility measure. If we start to see it come down from the March 27th peak, we have seen it actually come off a little bit on March 30th and March 31st. Let's see if it continues to come down. If so, then chances are we are very close to a bottom that investors anticipate will be put into place, and therefore diving back into stocks, taking advantage of what they think will be a very sharp rally off of a recessionary and bear market low. So with that, I'll say thank you for listening. Tune in on April 7th to listen to me talk about the market again. Also, Stuart Glickman talking about his outlook for energy stocks, and Todd Rosenbluth speaking about the new ways that CFRA ranks ETFs and mutual funds in the marketplace. Thank you and successful investing.